Well, it has just clicked over into 12 o'clock. So without much ado, we might get started into today's webinar, our March webinar on understanding your client's profile to build a good portfolio. And so welcome everyone. If this is your first webinar with us, then a very warm welcome to you. And if you're part of our growing list of regular attendees, then of course, welcome back. Now, this is the big one. We might click over into the next slide there, Nicki. Morningstar Advisor Roadshow. This is the big one for us. So the Morningstar Advisor Roadshow, it's a half-day agenda touring 5 cities: Brisbane, Melbourne, Sydney, Perth, and Adelaide, of course. The event brings together industry-leading insights for our advice community around the country, all designed and helping you better serve your clients and propel your business forward in 2023. Now, you'll earn CPD points as could be expected from such an event like that, and also have the opportunity to network with your peers and Morningstar leaders. And so I think we've got the registration link in the chat button. So dive on in there and register yourself for the Advisor Roadshow. Just next one in. Okay, so of course today, this is our disclaimer. Any discussion today is general in advice and general in nature. So it can't be relied upon for advice needs. Now, of course, housekeeping. Today's session is with the FPA for accreditation. Now, we typically get those CPD points within a week of today. So as soon as we receive them, you'll see those in your inbox. Now, in addition to that CPD email, you'll also receive a follow-up email containing a recording of this session and any other resources that we want to attach and send through to you. Now, importantly as well, next to the chat button is that Q&A button. So please use that. We certainly love engagement. And if I can say it before Ryan does, he loves being poked and prodded with questions and engagement. And I'm sure Nicki does as well. So please dive on in and ask questions as they come up. So with all that done, we might launch straight into it. Understanding your client's profile to build a good portfolio. Now, we're lucky enough to have 2 speakers today. I'll be moderating the session and handling any questions that come in, so I'll jump in when needed. But of course, we have Ryan Murphy, who's our Global Head of Behavioural Insights, and he is dialing in today from the US, but shortly afterwards, he'll jump in his car, jump in a plane and get straight over here for the Advisor Roadshow that I just mentioned. So he will be here for that. And Nicki Potts as well. Now, Nicki's in Australia. She's the Director of Financial Profiling and Planning for us. And with that, I think I might throw directly over to you.
Excellent. Well, very good. Thank you for that introduction. And thank you all to joining with us. I know time is valuable and I appreciate yours. So let me jump right into this. So what I want to do is show you the agenda of what we want to cover today. This is, like Dylan was saying, there's 2 of us speaking. I'll be covering the first points and then Nicki will be following the latter. I think for me, the job is a little bit easier in that I'm laying out these first 3 points, but the more complicated task is how to integrate and how to bring all of this together. And that's something we've been thinking a lot more about and what I'm excited to share with you today. And that'll be covered in the last part of the talk. But as always, as Dylan was saying, please feel free to send in questions, comments, challenges. The more challenging, the better. He already stole my punchline. My friends tell me I'm more interesting if I'm provoked. So with that being said, please feel free to jump in. So what I want to talk about today, what we want to cover on the agenda is, first off, talking about where value add comes from in financial services. And this is evolving. This is changing. The things that created value for investors some time ago are not necessarily the same as where value is today. And I think that there's more changes on the horizon. I think some of the major value add is going to be starting to bring together these very different components into holistic financial and investment guidance and being able to provide that for clients and want to start to build that case up here. Part of that is predicated on what makes for a good portfolio, and we have an answer for that, but it's one of those simple questions that's pretty complicated and easy to get wrong. These are some of the topics we'll be covering at the roadshow that was mentioned as well. So the talk I'll be giving as part of that, we'll cover this, what is a good portfolio, and also starting to get to my third point for today is what is a goal-centric investing approach all about? And there's some clear answers to what that is and also what it is not. And then lastly, Nicki will be bringing this all together, talking about how to balance these different components and bring that together into an integrated and holistic approach. All right, so moving on to the value add in investment advice. Where does this come from? So things are changing. It used to be that it was very much about stock picking, about kind of chasing results, these kinds of things. And that's changing substantially. And I think that that's not where a lot of value can be created. When people we know and end investors fall into this bad habit of chasing returns, it turns out badly for them. There's really clear evidence that shows people who constantly churn their portfolio or adjust their risk allocations underperform substantially, not just because of costs and churn, but they just have lower returns across the board. The fact is people are just not good at being able to anticipate and chase returns. And there's limits on how efficient we can make portfolios. The mathematics for this has been worked out, and that's really that. So there's not much more to push on that front. Moreover, it's becoming increasingly complicated because there's so many different investment options, and this can be overwhelming. So I think that it's not about creating new investment products. It's about being able to start to bring them together. And what I would argue is that the future is going to be about building and working collaborative relationships to help inform decisions that can help build good portfolios that can help investors get towards their goals. And this is predicated on understanding what good portfolios are about and maintaining focus on goal centricity. So let me move on to the next point here. The idea of goal centricity is not new, and it's not something that we came up with on our own. So this was from a piece of advice that we ran a couple of years ago, a piece of research looking at what investors valued and what they were looking for when they hired a financial advisor. And at the very top of the list, the thing that most people are looking for is a financial advisor to help them reach their financial goals. That's top of mind and first and foremost. And when you look on the advisor side, we asked advisors what they think people were looking for. This is a place where there's pretty clear agreement. There's other places where there's more disagreement. If these two sides were perfectly matched up, it would look like a ladder, but that's not always the case. But one of the really nice points about that research was that goals are top of mind for investors and advisors anticipate that. And I think that's a really good starting point. And it's worth keeping this in mind because the entire criteria for success around investing is helping investors reach their goals. So moving on then. All of this is incumbent on being able to answer this question, what makes for a good portfolio? And so this is one of those simple questions that I think has a rather nuanced and somewhat complicated answer. So if you're teaching Finance 101 or Economics 101, you open up the textbook, portfolio construction is very much about efficiency. So this is based on the seminal work from Harry Markowitz in 1952, 1958, setting the stage for how to think about portfolio construction. And in this framework, he demonstrates very clearly that there's always this trade-off between risk and returns. And portfolios are collections, bundles of securities, and we can evaluate them as a whole. And all the time, what we're trying to do is make sure that we make this trade-off in an intelligent way, trying to keep costs low, right? Because costs are just necessarily a drag on returns, and you don't want that. But all the while trying to create portfolios that have good risk-adjusted return. Part of this also highlights the benefit of diversification. This is one of the key parts, one of the key findings out of his work. And this can be extended further into the idea of robustness, being able to have diversification play out well over market cycles and very different market conditions. And all of this is important. I'm not suggesting that any of this is not. This is critical and it's essential, but it's not sufficient to answer the question of what makes for a good portfolio. In many ways, the things on the left there of this efficiency is about investments. But if we want to answer the question about what makes for a good portfolio, we need to also take into account investors. And that's where I would argue we'd have to start to think about the efficacy of the portfolio. Does this portfolio actually help the investors reach their goals? And is this compatible with their risk capacity, their timelines? Is it endurable to the investor? We know that different investors have different risk tolerances. Some markets are much more volatile than others, and that can induce people to sometimes make bad choices, fiddle with their asset allocations, and not hold the portfolio they should. And what's the point of building a portfolio for clients if they're not able to hold on to it for the long term? It's going to undermine their ability to reach their goals. And lastly, there's been a lot of discussion, a lot of ink spilled on this in the last 5 years or so around the notion of bringing values or ethics into the investing process. I view this as an optional, sort of an add-on, a way of thinking. Once the other pecuniary aspects are met, these non-pecuniary aspects can be taken into account. But there are clients who have very strong views as to what sort of values or preferences they have that they want to see bore out in the portfolios they hold. And again, this is very much about personalization and tailoring the portfolios to the clients. This, I think, is a holistic approach, thinking about what makes for a good portfolio. And this is part of a holistic guidance framework, building a plan that serves all of these different things simultaneously in an effort to assist and coach individuals in making informed decisions toward the achievement of their financial goals by balancing these different components I was talking about. The goal centricity, right? So this, you'd have to back out what's the required risk, what's the required returns from this portfolio to have a good chance of reaching their goals. Does the client, do they have the sufficient risk tolerance? Are they comfortable with the amount of volatility they're likely to experience? We think of their risk capacity. When you think of their portfolio over the entire life cycle, is it going to get them where they need to go? Or are there other risks like shortfall risk that they need to be mindful of? And the non-pecuniary factors I was talking about. Now, some of this is very much a math problem. Some of this is figuring out what an efficient portfolio is, anticipating its returns, determining if it's sufficient returns to get to goal are all matching up. That's very much a math problem, but at the same time, it's a math problem informed by the psychology of what people are trying to accomplish, what their goals are, what their risk preferences are, and the other sorts of non-pecuniary preferences they might have. And that's a complex thing to get all together. So central to this on the next slide. Oh, yeah, Dylan.
I might jump in at this point. Let's turn our attention to the client advisor dynamic for a second. What if, for whatever reason, the client can't tell the advisor that they have any goals?
Oh, okay. I think that's a great part. It's a great moment to start a very meaningful conversation, right? So, like, what is it, Yogi Bear? If you don't know where you're going, you might not get there. And if people don't have clear goals, then there's not really something that they're aiming for. We can't tell if they're on track or not. I think that what financial advisors can do is start that conversation about what motivates people, what drives them, what they're trying to accomplish. I mean, being an investor is not easy. It requires enduring quite a bit of uncertainty. It requires putting money at risk. It requires delaying consumption, all of these things. And I think people need to have a very clear why in their heads they're investing in the first place. So I would think of that as a great opportunity for a financial advisor to lead that discussion and start to dig deeper to understand what motivates people. Because everything I'm talking about next, if people don't have goals clearly set out, then it's really hard to tell if they're on track, whether or not it's a good portfolio, and so on. Yeah,
Perfect,
thanks for that.
you.
So let me emphasize that this question is a great lead into where I'm going next with this, that goals are absolutely fundamental to this. And if you don't have that squared away, then a lot of the rest of it doesn't make sense. So let me be very clear and maybe even emphatic about what I mean when I talk about a goal-centric approach. So when you think about a goal-centric approach to financial advice, this is a strategy that has an objective function that is explicitly based around the goals the investor has. So you have to articulate what those goals are, and that's some sort of amount of money that the person wants in a particular time frame, right? So those specific details have to be delineated. And part of what this system can do then is deliver guidance that is specifically tuned to help the investor reach their goals. Part of what the main drive is the required rate of return. So if clients have very ambitious goals, then they're going to need to have portfolios that are also producing quite a bit of returns, a lot more equity exposure. So I really like the metaphor of thinking about an airplane coming in for landing. This is an automated control system. A complex computer program is adapting to the airplane's movements to the changing environment around it. So if the plane all of a sudden encounters some headwinds, the plane starts to adapt by moving a little bit more thrust. Or if there's an unexpected upcurrent, then the plane starts to dip its nose slightly, right? Highly adaptive, changing. But notice what the airplane system is doing here in conjunction with the pilot is keeping the airplane on track to its goal of being able to have a nice, smooth landing on the runway. That's the goal. And the entire system is adapting and keeping that in mind. Okay. So from an investing standpoint, if there's substantial market headwinds, then a client might have to save more, might have to take on more equity exposure. If there's all of a sudden updraft, good fortune raises the plane, then okay, then there might be an opportunity to spend a little bit more, or maybe even bank that savings, lock it away, and decrease risk exposure. There's always this dynamic process, but what dictates this is whether or not the system is on track for goals. This isn't the case. There's lots of other approaches that are used currently in financial advice. So for example, there's a risk preference approach. There are some firms that give people a risk tolerance questionnaire of some sort, and they get a score, say, between 1 and 99. This client gets an 88, they map that into a particular portfolio, and the asset allocation process is done. That's it. That's the only input for this particular portfolio. And as you can see, goals don't come into that at all. This is not goal-centric, and probably not a great way to give advice, because there's no reason to think that a person's risk preferences should be the main driver of to make investment choices. There's other approaches as well. Glide paths are commonly used. This is a decreasing equity exposure over time based on the person's age. Now, generally, it makes sense to decrease equity exposure because as a person is getting older, they have less time to make up potentially lost ground. So in that way, it's prudent, but it's not adaptive. It's certainly not smart. This is something like a paper airplane where you aim it as best as you can and give it a throw, but there is no adaptation or adjustments based on changing environment around it. And there's some other systems that use a hybrid approach, sometimes just called an RTQ approach, which takes some sort of mathematical function, typically a min between people's risk preference score and something like a glide path, their time horizon, and puts that together into the asset allocation determination. But again, goals are nowhere in that equation at all. So I would say that if we want to give good financial advice and build good portfolios for people, they need to be tailored to the kind of goals that they have, what they're trying to achieve. And I think that is a little bit different than how some firms approach this. All right, next slide. So this is where we're coming to lots of discussions with Nicki as well as others around this, changing how we think about what constitutes suitability. And the goal here is to match investors with financial advice, with strategy, with investment products that are appropriate for their circumstances, their personality, their capability to tolerate that risk, and their goals. And goals is the bedrock of this whole system. So it's goal-centric in the sense that investors' goals are front and center, and the entire reason they're investing is to try and help them achieve that. Of course, there's proper consideration while maintaining, understanding what people's emotional state is, how much variance they can tolerate in their portfolio value over time, and whether or not their time horizon, their capacity are lining up with what they want to do. And there's an optional consideration here, which has to do with non-pecuniary preferences, people's values, that might be used as a tilt on what sorts of portfolios they want to invest in. Now, obviously, this is a really complicated problem. And the way to deal with this is not going to be trying to solve it all at the same time. So what we think it can be a very useful approach is starting to think about this sequentially. First and foremost, starting with goals, making sure that those are set. And let's just assume for the sake of argument here, we know the client's goals, and that's that. Moreover, let's say that these goals are rather ambitious. So this client has rather ambitious goals. And so that would require them to have a portfolio that has quite a bit of equity exposure. Are they going to be comfortable with that? Some clients are, and so you have good harmony between these two facets, but other clients may not be. So what do you do then when a client has very ambitious goals, but very low risk tolerance, low comfort for this? Well, something's got to give. There's no free lunch, and there's no way just to gloss over this. That is an opportunity to have to talk through what the trade-offs are. People maybe can save more. Maybe they can retire a little bit later. Maybe they make their goals a little bit less ambitious. Or maybe they start to recalibrate what normal variance is expected over the timeline for them as an investor. But once you start to get a squaring between their goals and the amount of risk comfort they need, then you start to get into capacity to see how this kind of strategy would play out over the long run. Imagining good markets, bad markets, and the kinds of cycles we all expect. Some clients still ask if they're going to go through a recession. It's not if, it's when and how many, and making sure that the portfolios that are designed in the strategies are robust to these realities, making sure that squares up. And if it does, then it makes sense to go on to the next step and maybe talk about if there's values or non-pecuniary preferences they have, and perhaps not. But the thinking here is to break this down, this very complicated problem down into subsets and solve each of these smaller problems by itself and to do so in this sequence, only moving on to the next step in the sequence once things have been squared, and then continue this process. And this isn't done once, fire and forget. This is part of the ongoing adaptation that advisors create as value for their clients as there are changing market conditions, changing life conditions, and so on. Always adapting, like the airplane, to what's going on around it and keeping the client on target. Now, Nick is going to go into a lot more details about these trade-offs and the sequence there and go into a discussion there, but I will be here and I would welcome, actually, before we get there, if there's any questions for me, before we go on to the next step.
Handled a few as they came through, and I mean the big one was sort of outlining what it was in terms of that initial goal conversation that the advisor and client should be having, and have that teased out in a deeper conversation. So
yeah, well, that's come see me during the roadshow, and this is what we're going to be showing. We have some new research along these lines, because asking people off the top of their heads what their goals are tends not to work. And we have some new research showing some additional tips and tools that advisors can use with their clients to better help clients articulate what drives them as investors. And I think that can be a very useful starting point. But we're glossing over that for now, and we're saying, okay, let's assume that we know people's goals, then what's the next step in this holistic process? All right, Nicki, I'll turn over to you, please.
Thanks, Ryan. Okay, so Ryan went through the various components of the framework earlier. What I'm going to do is essentially run into a deeper dive of how to balance those components in the framework. So the holistic guidance framework starts with the investor's profile factors along the y-axis there. These are the factors that an investor must balance and trade off against. So we have required risk comfort, capacity, and non-pecuniary preferences. Then on the y-axis, we have the CFP's 7-step financial planning process. The core components shown there in the solid line boxes are your foundational pieces. They're your must-haves, with the optional enrichment components shown with the dotted line boxes that allows firms to customize and scale their user experiences based on their clientele and or the service levels you're offering. The general sequence is to move from the left to the right, and it's designed to be iterative in nature so that the user can understand what trade-offs are needed at each stage. Now, there are 4 key trade-off decisions in the framework highlighted there. We'll explore each of them individually. The first is required risk. That is, given the investor's goals, is there a plausible target strategy available that serves these goals? And if so, which of these strategies is the most efficient in doing so? So this first step is solely about the math of defining realistic goals, savings rates, timeline, capital market assumptions, investment strategies, and so forth. What we want to do is maximize the probability of achieving the goal within a given acceptable range. We don't want to underfund the goal, which is clearly not in the best interest of the investor, but neither is overfunding the goal, where the investor is not enjoying the funds sufficiently. So if you happen to have a shortfall, as Ryan said earlier, the investor can adjust available levers such as increased savings, delay retirement, have less aspirational goals until a plausible strategy is found. If, on the other hand, the goals can be easily achieved given the expected returns of even the most aggressive strategy, then where the goals is overfunded, then the reverse would apply. So go and spend more, retire earlier, have more aspirational goals. The key elements here are having well-defined realistic goals. So take the time to define these goals with the investor to start with. Then have a robust cash flow and strategy engine that enables you to compute the plausibility of achieving the goals. So here's an example of what that can look like. We have a simplistic goal of reaching 50,000 from 40,000 in 5 years' time. The acceptable range is set at 10%, so you get a range of 45 to 50,000. And what you want to do is maximize the probability of being in that green acceptable range. Now, once required risk is resolved, then and only then can we turn our attention to risk comfort. To what degree is the goal-serving target strategy within the risk comfort range of the investor? In other words, is the expected volatility psychologically tolerable to the investor? Risk comfort is more of a concern when the investor's goals require a more aggressive strategy than they are comfortable with. So, like required risk, the investor can adjust the same set of available levers until the target strategy is within their risk comfort, or alternatively, learn to become more comfortable with market ups and downs. That is, consciously choose to balance required risk above risk comfort to a degree. So the investor is essentially taking risk outside of their risk comfort knowingly, willingly, and has signed off on it. Here, the financial professional's role is to explore expected volatility in the long term and manage risk and return expectations. If required risk is less than risk comfort, then the same levers as before would apply. So the key elements here are having a robust risk tolerance assessment, so a valid and reliable tool so you can rely on the results, and mappings to suitable strategy. That is, how do you translate the results of the risk tolerance assessment to portfolio strategy? And finally, historical backtesting to help manage risk and return expectations. So here's an example of what that can look like. The investor's risk tolerance assessment is translated to a comfort range of between 36 and 55% growth asset, the green band you see there. And the investor's target strategy currently sits outside the comfort range in the red area. Now, by separating these elements, the investor can clearly see A, whether the target strategy is within or outside of comfort, but more importantly, to what degree. So there's a limit to how much can take someone outside of their comfort. Being marginally outside your comfort is different to being significantly outside your comfort, where panic sets in, leading to behaviors that are not in the best interests of the investor. So once risk comfort is resolved, we can then turn our attention to risk capacity. To what degree is the target strategy compatible with the investor's risk capacity? So can the target strategy withstand negative events or sustain underperformance? Now, while risk comfort looks at volatility risk generally, because there's a general risk tolerance factor that's agnostic to goals, the first prong of risk capacity explores the many other facets of risk. For example, the sequence of returns and cash flows over multiple periods, and looks at risk from the standpoint of potential goals shortfall. So this is where Monte Carlo simulation and stress testing play a vital role in demonstrating potential end states. Again, investors can adjust available levers, such as varying the timing and size of withdrawals until the target strategy is within the investor's risk capacity. Then the second prong of risk capacity is composure, which is essentially the investor's emotional state when markets go up and down, and looks at whether the investor can essentially stay the course. Now, this can be partly mitigated through education and behavioral nudges. For example, not looking at your portfolio every day, holding fewer liquid securities that are designed to encourage behaviors in the best interests of the investors. But generally, it is not advisable for investors to take on investment strategies that are beyond the risk capacity. So,
Nicki,
yes.
you may well be covering it later, but an advisor's jumped in early. And just going back to the required risk in growing the savings from 40 to 50 grand, do we have a tool that helps the advisor actually illustrate the maths behind that? So to illustrate that those probabilistic outcomes that you've used in that slide?
So currently, we haven't seen, there are tools out there in the market that you can calculate these sort of probability, but we haven't seen anything sophisticated enough to be able to do the full calculation that I've mentioned earlier.
See, Ryan turned his camera on. He's maybe looking to jump in here as well.
No, I was just nodding. Yeah, I think that, this is the maths problem behind that, and there do exist tools, but I think that what we're lacking so far is a workflow that brings all of this together holistically and seamlessly. And that's a big lift to start to put together. So I think we can point to different components here and there that come from some of the tools that we have at our disposal. But what I think Nicki and I are starting to contemplate is putting these together into a workflow that would be a much more seamless transition that would allow advisors to keep clients on track in a goal-centric way and take into account these other features that we're talking about much more holistically. So I think the answer is no, we only see parts of it, but our aim is in the next years to be able to have something along these lines.
Yep. All right, thank you. So I'll just move on. So on risk capacity, where the key elements here are, again, having a robust cash flow and strategy engine to illustrate those various end states and stress testing the plan, and behavioral education and coaching. So here's an example of what that can look like. Presented on screen is a Monte Carlo simulation of a decumulation phase, showing the various end state possible. Now, capacity is about evaluating whether the worst case scenario is going to jeopardize the achievements of goals. Usually that's set at, say, the 10th percentile, and that's shown in the yellow line there on screen. Here, the investor is looking at, having no funds by the age of 87. So the conversation can go something along the lines of, is this acceptable? If not, let's explore how we can extend the funds. So once risk capacity is resolved, we then finally turn our attention to non-pecuniary factors. So to what degree is the strategy attuned to the investor's non-pecuniary factors? As said earlier, some investors look beyond risk and return trade-offs and see investment selections, whether it's positive, negative, exclusion, inclusions, as a way to express their personal values. Values-based investing, together with the investor's experience and knowledge, are all, as said earlier, optional enrichment components in the guidance framework, because they may change the composition of the investment selected, but should have limited impact on the overall risk and return investment strategy. However, should such preferences require a more aggressive strategy, then again, the investor would need to return to the goals to adjust the available levers. So the key elements here are capturing the investor's preferences. So you can do this either through a formal assessment or a few questions during the fact-find process. And understanding the level of the level of financial knowledge and experience of the investor. Again, this can be done through the fact-find process. So here's what that can look like, where ESG filters are applied to align products with investors' preferences. Now, remember that while preferences are great for personalization and engagement, they can have a meaningful impact on the investment outcome. So it's important for financial professionals at this stage to provide guardrails and not get carried away with preferences selection. On the knowledge and experience side, this has an impact on the complexity of the products recommended. So newer and less experienced investors may not be comfortable with certain investment types. So a go slow strategy may be advisable where you start with more traditional asset classes before easing them to more adventurous asset classes in the long term. So in summary, when it comes to balancing the investor's profile, start with a strategy that meets the investor's financial goals first. Then adjust for comfort and capacity if required, before fine-tuning to non-pecuniary preferences as a final consideration. So that essentially brings me to the end of the formal presentation side of things, and we can now open up for any questions if there are any.
Yeah, there was one that came through as well, Nicki, for you. You've outlined quite a process there, following those steps in a systematic way versus the advisor sort of jumping around. What would be your feedback on that one?
I think it's like Ryan and I both agreed that it's important to be able to do these trade-offs in a sequential manner, because if you try to get someone to trade off multiple factors at the same time, it becomes very overwhelming and they get confused, and in the end they don't really quite understand what they're trading off. So it's quite important to do each step sequentially. They understand what they're trading off at each point, and then if it doesn't work, it goes back to the goals and then follow the same process.
Yeah, and just to build on that, there's a natural logic to this, that you need to start with goals. If you don't know what the goals are, then you wouldn't know what the required risk rate is, right? And you can't then start to say what the anticipated volatility is for this client strategy. One advantage of this is that when you start to have those conversations about risk preferences or risk tolerance, you can do so not in the context of an abstract, imagine $10,000, but you can talk to the client about their strategy. Your goals would require to have 85% equity exposure. that's what that's going to look like for you, and you have $200,000. So given how markets go, it's conceivable you could lose $35,000 in a year. That's realistic. Are you up for that? And I think just having that conversation up front helps people know what to expect rather than the abstract, your portfolio could drop 18%, but rather brings it to the concrete of here's what you're going to experience. And I think that's really essential for being able to coach people through the natural volatility that's inherent in any of this investing we're talking about.
Okay, we thought that the webinar today would run for about 45 minutes. So we love giving people some time back in their day. In the absence of any other questions, we might move to start wrapping up. But while I do have the microphone, it would be a good chance to remind everyone if you haven't seen it yet, in the chat function, there is the link still there to register for the Morningstar Advisor Roadshow. That starts next week. As we take that around the country. So that would be my last final plug. But with that, and there's no other, we have been seeing some things there. So thank you. So with that, massive thanks to Ryan. We'll see you next week here in Australia. Thanks, Nicki, as well. And we'll see you for the next webinar.
Very good. Thank you.
Bye.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.